Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, it's 4:30, so I think we should start. I want to thank everyone for coming to today's webinar, and I want to thank Ron for presenting today. This afternoon's webinar is hosted by Ron DeLegge, he's going to be teaching us about shorting the market using inverse and leveraged ETFs. And just a little bit about Ron. He's the weekly voice of the Index Investing Show at indexshow.com. And as a former investing advisor for 11 years, he's personally helped people to reach their financial goals through index investing. Ron also serves as the editor of ETFguide.com, and he writes for Research Magazine. Ron is originally from Chicago, but he resides in Southern California. So with that, I'd like to turn it over to Ron, and I want to just remind everyone, if you have any questions, to use the chat and the Q&A over on the right side of your screen.
Mike, thank you for that stunning introduction. I'd like to thank all of our webinar attendees and, of course, the International Stock Exchange and all the hardworking people behind it for organizing this event. I think it's a very timely subject, shorting the market using leveraged, inverse, and leveraged ETFs. Now, in our discussion of this topic, we will be tackling this subject, hopefully, in an easy-to-understand way. I've tried to use, and you'll see in my presentation here, I've tried to use as few statistics as possible because not only are they boring, but unfortunately 99% of all statistics only tell us 49% of the story. So let's begin with a snapshot. A snapshot of the inversed and leveraged ETP market. And ETP, by the way, is an acronym for exchange-traded product. It basically encompasses not only exchange-traded funds, but also exchange-traded notes, also known as ETN. Now, inverse ETFs, inverse ETPs are also known as bear products or short products. So they go by several names, not just inverse. So bear, short, inverse, all kind of the same thing. Now, the inverse leveraged ETP marketplace here in the U.S., which again includes not just ETFs but also ETNs, which share very similar characteristics to ETFs, almost $20 billion in total assets under management. This, by the way, is a business that in 2006 was at zero. So we've seen some pretty tremendous growth over the past 5 years. There's 120 total products, including ETNs that attempt to go short the market and then short the market with leverage. Various asset classes being covered or investment categories. You've got U.S. stocks, international stocks, government bonds, commodities, real estate, and also the VIX index. Now, just a quick difference between exchange-traded funds and exchange-traded notes. We alluded to it earlier, both products are very similar, but ETNs have credit issuer risk, which means if the ETN issuer defaults on their debt or goes bankrupt, there's a good chance you might lose your entire investment, which isn't good. Now, this happened several years ago when people invested in ETNs issued by Lehman Brothers. So for that reason, I think, and this is just my opinion, I think most traders, I think most investors, I think most financial professionals should steer clear of inverse and leveraged ETNs and just stick with the ETFs. In my view, there's enough market risk in these products as it is. Adding further burdens like credit risk, to me, it's just simply not necessary, especially when inverse and short ETFs in the same investment category are already available. Now, the first group of short leverage ETFs was introduced back in 2006. So these products have had a couple of years under their belt of trading history. Now, inverse ETFs, what is the best benefit. Does everyone understand the difference between unleveraged and just regular inverse ETFs? Well, let's just begin with regular inverse ETFs. In other words, ETFs, inverse ETFs without any leverage. And then we'll get into the latter very shortly. So unleveraged inverse ETFs are 1X or 1 beta daily products. They allow you to capitalize on downswings in the market. They allow you to hedge long positions that you may have in your portfolio. They are also an alternative to outright shorting or buying put options. And again, unleveraged inverse ETFs are 1X, 1 beta products. In other words, they attempt to deliver the exact opposite of whatever index they're tracking. So just to use it as a simple example, if the S&P 500 is down 1% for the day, then a 1X or 1 beta inverse ETF will aim for a positive 1% daily performance gain. Again, they're aiming for the exact opposite or inverse of whatever the underlying index is, and of course, without leverage or without magnification. Now that brings us to the next slide, or next point, which is leveraged inverse ETFs, which basically do all the same thing as regular non-leveraged inverse ETFs, except with the fact that they're using 2X and 3X daily magnification. So those are the primary flavors offered by today's ETF providers, 2X and 3X. Think of leverage as a fast race car, or for those of you that like to cook, like myself, think of it as chili pepper, which can add some zip to your dish. Of course, if not used correctly or cautiously, it can also burn you. So the idea, though, here behind 2X and 3X leveraged ETFs, they're attempting to deliver the exact opposite of whatever index they're tracking, but with daily magnification. So, for example, if the S&P 500 is down 1% for the day, then a 2X inverse ETF will aim for a positive 2% gain, whereas a 3X inverse ETF will shoot for a 3% performance gain. So to obtain the necessary exposure, what the leveraged ETFs are doing is they're investing exclusively in derivatives. They're using swaps or futures contracts to obtain their exposure. These derivatives are basically agreements that provide the ability of the ETF provider to gain exposure to specific indexes and sectors without the need for full dollar-for-dollar investment. And this, by the way, is quite different than leveraged long ETFs, which will usually hold a combination of both equities along with derivatives. So just a little bit there on the mechanics of these products. And then going a little bit further, that I think it's very important for all of you to understand is that all of today's leverage ETFs have daily goals. So the fund company, what they're doing is they're rebalancing their exposure daily by buying or selling swaps or futures contracts to ensure that each of the fund's total daily exposure is 2 or 3 times its net assets. And this allows the fund to track as closely as possible its multiple, the benchmark's daily performance. Again, these funds have daily objectives. That's key, and that I think is going to be an ongoing theme here of this presentation. Daily objectives, not monthly, not weekly, not annual. And for that reason, because of those daily objectives, they're aiming to get that 2 or 3 times that daily performance, whatever that index is. For that reason, they are best used as short-term trading vehicles, not as long-term bets. I'd like to go back just quickly about one of the reasons I think that short and leveraged ETFs have found a place with traders. I think one of the reasons that they've succeeded is because of the fact that they bypass some of the strict margin requirements for selling short securities. And I don't want to go off into it in too much detail, other than to say that the Federal Reserve, under Regulation T, requires all short sale accounts to have at least 150% of the value of the short sale at the time that the sale is initiated. So that 150% requirement consists of the full value of the short sale proceeds, plus an additional margin requirement of 50% of the value of the short sale. In the context of the New York Stock Exchange, the maintenance requirements for short sales are 100% of the current market value of the short sale, along with at least 25% of the total market value of the securities in the margin account. Keep in mind, everybody, if this is minimum, it can be adjusted upward by your brokerage firm, whoever that is. Many brokerages have higher maintenance requirements for selling short of 30 or 40%. But again, none of these strict margin requirements apply to short or inverse ETFs, and I think one of the reasons that these products have found a place and have succeeded with traders is because of that, those strict margin requirements for short selling securities. So they offer an alternative, a way to get around that. Let's move along to the next question, and this is a very big question. This pertains to those of you already using leveraged or inverse leveraged products. Which ones do you choose? So do you choose a 1x, do you choose a 2x, do you choose a 3x? It really boils down to your level of aggressiveness as a trader or as an investor. Of course, the 1 beta or 1x products are the least aggressive. On the other hand, the ones that use leverage, like the 2x and the 3x products, are clearly the most aggressive. So a lot of this depends on your particular take, your particular hunches, what type of bets you want to make, how aggressive you want to be with those bets. Of course, with the leverage products, the 2x and the 3x products, if you're making a leveraged hunch or leveraged bet, you better be right. Because as great as leverage is in magnifying your gains, it can also magnify your losses. So you have to be sure that your hunches are quickly fulfilled. And then, too, the other big factor is your time horizon. Your time horizon is basically a fancy way of saying, well, how long do you have to let your investments blossom or grow? And some of you have a short-term time horizon. Some of you have an intermediate-term time horizon. Some have a long-term time horizon. And as we alluded to earlier, all of the inverse or bear ETFs that currently trade today have daily objectives, and that makes them suitable for traders with a very short time horizon. So put another way, if you have a hunch and you expect it to unfold within a matter of weeks, maybe a few days, then the inverse ETFs are probably a good choice. But if you're expecting your bearish opinion to take 3 to 6 months to work itself out, or maybe even longer than that, well, you should probably be looking at other investment vehicles, maybe put options with longer expirations, or maybe other methods for obtaining your short exposure. And this is, the next thing is, what is your favorite investment theme? And at ETF Guide, we like to organize our ETF picks according to unfolding investment themes. We use themes to help us organize our ideas. Themes help us to track our investment ideas. They help us to pick the best ETFs that help execute, hopefully, a profitable trade. And I think this is where inverse and leverage ETFs are best used, particularly for investment themes over shorter periods. I think this is the way for traders and investors to be organizing their thoughts, their best ideas in terms of themes. So think about the global investment landscape and all of its chaos and all of its confusion. Think about it in terms of themes. So whatever themes you believe in, there's probably a corresponding ETF to trade. So I've just highlighted here 4 quick examples of potential themes. First one is you believe interest rates are headed higher. So which particular inverse, along with inverse leveraged ETFs, have the potential to profit from that trend. With ticker symbol TBT, TMV, TYBS, and TYO, examples of products that are designed to increase in value when interest rates go up and bond values fall. Another theme is if you want to capitalize on the seasonal weakness in precious metals. And we've seen this just recently, the fall off in precious metals, which have had a marvelous run. So, if you look at this from a seasonal perspective, historically, precious metals have been weak, usually from about April through the end of June. And so which types of ETFs, inverse performing ones, stand to benefit from that? Ticker symbol GLL, DSL, and BUST, which all perform opposite to precious metals themselves, along with stocks tied to precious metals. How about the theme of oil prices topping? If you're one of those that believes that oil prices are maybe heading down or are going to stay the same, see ticker symbol ERY or UCO. These are funds that potentially can benefit from that trend. And then lastly, those of us that think the 2-year rally in U.S. stocks is way overdue for a correction, here's a few ticker symbols that stand to benefit from that. Ticker symbol SH, SBB, DGZ. So organize your ideas in terms of investment themes. I think it can help in many, many ways in getting your trades lined up and so forth.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.